You're not spending enough in retirement. That's the conclusion from this research paper. Now, that matches my experience working one-on-one with new retirement planning clients. Many retirees are not spending to their full potential in retirement. And in this video, we want to explore some of the reasons why. We're going to summarize some of the key findings from the research paper. We're also going to share some of our own observations from working one-on-one with retirement planning clients. We want to share a couple of strategies that you can use to avoid a similar mistake with your own retirement plan. Spending in retirement is surprisingly difficult, especially when you have more than enough to meet your basic living expenses. Spending more on discretionary spending like travel, hobbies, and entertainment is actually surprisingly difficult for retirees. One of the interesting insights from the study that I want to share is this one. It says that retirees are consistently spending about 75% of what they could spend from available assets, and this underspending increases with age. That means if a retiree is spending $75,000 a year, an average retiree, their potential spending, according to this study, could be as high as $100,000 a year. That's a $25,000 a year difference in potential spending in retirement. The other insight that I want to share is this one here that says that retirees who hold a higher percentage of their wealth in guaranteed income spend more than retirees whose wealth consists primarily of non-annuitized assets. That means if you hold a higher percentage of your retirement assets in things like investment assets, equities, bonds, cash, versus things like pensions, CPP, and old age security, if you've got more money in investment assets, chances are there's a higher chance that you're going to underspend in retirement. Now, what I've noticed working one-on-one with retirement planning clients is that often they're afraid of running out of money in retirement, and that can lead to them using things like the 4% rule as the basis for their retirement plan. Now, the 4% rule is great. It definitely helps identify a safe level of retirement spending. It's a great way to identify a retirement spending level that is successful in many, many historical periods. The problem is that we're planning for the worst case scenario when we're using the 4% rule, and anything that is better than the worst case scenario could lead to a lot of money left over at the end of retirement. This leftover money represents the potential spending that could have been earlier in retirement. Now, what I want to do is I want to walk you through an example here of how we can adapt a retirement plan to be more flexible. Now, we talked about this in the last webinar that we did. I'll put a copy to that webinar in the description for this video. In that webinar, you'll probably remember that we did a similar case study as the one that we're about to go through, but they had a lot of pension assets, pension, CPP, and old age security. And as we know from that study, we know that the pension, CPP, and old age security, they're guaranteed income sources, and the chances are that that retiree was going to spend more of that income because it's guaranteed. In this example that we're about to go through, there are a lot of financial assets rather than guaranteed income sources in retirement. So we've got $2 million in a registered account, $400,000 in tax-free savings accounts, and we're spending quite a bit here in retirement. We're spending $152,000 in early retirement, $122,000 in mid-retirement, and about $107,000 in late retirement. Now, this retirement plan is somewhat successful at 74%, but we can see that there is a chance of running out of money here later in retirement. Now, it's later in retirement, it's definitely age 85, 87, 89, and after, but the client might be concerned about that potential chance of running out of money. Now, what they might be focused on is increasing that success rate to 100%, and we'll definitely run through that scenario, but I do want to highlight why this is a problem when it comes to retirement planning. Although in 26% of the chance here, 26% of historical periods, there is a chance that we'll run out of money. There's a chance that we need to reduce retirement spending. There's also a 74% chance, 74% of historical periods that end up with a lot of money left over at the end of retirement. So when it comes to retirement planning, we want to have our target retirement spending like this example has here, but we also want to have a safe level of retirement spending and a max level of retirement spending. So let's go through an example here. Now, if you want to do this for yourself, you can go to advice.ca, you can sign up for your own account, you can use the platform to create your own retirement plan. You can use the software, the AI strategies. We also have a community forum for support, and we do 2 webinars every month supporting you in creating a retirement plan. Now let's go through this example. We've got a fairly good success rate, but the client wants to know what do they need to do to make it more successful. That's actually fairly easy to do with the AI strategies. We're going to filter here on the modify retirement spending strategy, and we're going to look at what we need to do to reduce retirement spending to increase the success rate. Now again, the AI strategies do this for us. They're already exploring these retirement decumulation options in just a few seconds. And we can see here that reducing spending by about $18,000 a year throughout retirement would increase their success rate to 99%. So let's take a look at what that looks like. But again, this is a safe level of retirement spending. In 99% of cases, we're going to have a lot of money left over at the end of this plan. So this would be your typical kind of 4% rule plan. It's a great safe level of retirement spending. In this case, they're still spending $134,000 a year in early retirement, but most of the time we're ending up with a lot of money left over at the end. So this would be a safe level of retirement spending based on all the historical periods of the last 100 and 120 years. This is a very safe level for these clients to target in retirement. But this only applies in the worst case scenarios. So let's take out that AI strategy here. Let's go back to the original case that we had. So target retirement spending, 74% success rate. Let's also identify their max retirement spending. So what if things go according to plan? What if things go better than plan? What if we're in these upper historical periods where potentially we retire and we see some of our retirement assets actually grow in retirement? How much can we increase retirement spending in those cases? Well, let's take a look here. We can re-rank the lifetime spending. We can take a look at increased spending strategies. We could do something like increasing spending over the entire retirement period. So we can maybe add $18,000 over the entire retirement period. This gives us really good guardrails for retirement. We've got minus $18,000 on the safe side. We've got maybe plus $18,000 on the max side. But we typically want to front load retirement spending. So let's instead look at this strategy, which is increase the go-go retirement spending until age 75. And by doing that, we can actually front load $30,000 a year and still have a 57% chance of success. So let's rerun this strategy. We've got 56% chance of success here. We've got a net worth that does decline over time. So we do know that this is certainly pushing the limit in terms of total retirement spending. But now we've got in early retirement as much as $182,000 a year if things are going according to plan. So if we're in these 50% cases or above, it certainly seems that we can spend quite a bit more in early retirement. This gives us really good guardrails. On the downside, the safe side, we've got $18,000 reduction in spending. We know that that's quite safe. And on the upside, we've got as much as $30,000 in additional early retirement spending as long as things are going according to plan or better. This gives us great guardrails for retirement spending. It also helps us ensure that we're not planning just for the worst case scenario, and we're actually planning for some better or best case scenarios as well. As you can see, when it comes to retirement spending, we definitely want to identify that safe level of retirement spending. But just targeting that is going to be way too conservative when it comes to a retirement plan. Most of the time, we're going to be able to spend more than that safe level of retirement spending, sometimes a lot more. Depending on your investment assets, your guaranteed income sources, you want to identify a safe level of retirement spending, a target level of retirement spending, and then the max level of retirement spending. That's going to help you identify and avoid missing out on potential retirement spending, especially in early retirement. Thank you so much for watching. I'd love it if you like and subscribe, and we'll see you at the next one.